It's important to get the basics right, whether it is an examination, whether it is a course, whether it is a sports, games, movies, acting, whatever. You want to get your basics right. Same is the case with investing. But what I see is, when it comes to investing in markets and companies, people do not follow the basics right. They just tend to skip those basics and just go and start investing directly. But take it from me, these four basic things are important when you're a beginner. What are those basic things? First one, stock ticker prices means nothing. Ticker prices, example, Apple trading at $190 does not mean it is cheap, and Tesla trading at $500 does not mean it more expensive than Apple. It's not how you look at the market pricing. A market pricing of a company is determined by market capitalization or an enterprise value if you add debt to it. So market capitalization is nothing but the total number of outstanding shares times the per share price. Now, market capitalization is a determinant of how much the market is pricing the company in. And our job as investors is to find companies that has better value in future than what the market is pricing in today, right? What do I mean? That a market is underpricing as asset or a stock, and the real value is much more, then you have found a great idea to invest in. But if the market is pricing in the future growth or way ahead, and there is not much value left, then you are overpaying for that idea, right? So understand how much the market is pricing in, and our investor job is to find the real value and then find the delta and see if the value is much higher, then only invest in that idea, right? Second, there is a business behind stock prices, stock market tickers, right? Stock tickers, just because it fluctuates, gyrates in price, it doesn't mean anything, right? People tend to have the tendency to keep buying and selling because it keeps fluctuating. But if we really understand that we are investing in a business or a part ownership of a business, with that mentality, you should understand there is a business behind these stock tickers. And we invest in these businesses for the future growth of these businesses. How much the business is going to earn in the future or the next 10 year of invested period, that is the returns, the investment returns that we are going to get. The share returns, share price returns exactly reflects how much the company is going to earn in the future. But there is a price multiple factor to it, which I'll get into it later. But at the beginner level, understand that there is a business behind the stock tickers. The third basic is, stock market returns are non-linear in nature. They are never linear. For example, if you invest in a bond, the returns are linear. You know how much you're going to get approximately, and it is a consistent returns. But when it comes to markets and company investing in a company, the returns are highly non-linear, which means 80% of a return would come from 20% of time invested period. Like what I mean, if you invest for 10-year period, your 80% of return during that 10-year period would come from 20% of that invested period time. If you invested for 10 years, those 2 years to 3 years will give you almost 80% of your shareholder return, right? That's how stock markets work. It's highly sporadic, it's highly non-linear, right? And you need to have the patience to stay invested for the rest of the period. You cannot really know which of that 10-year period is going to give you that return over the 2-year period that gives you the return. So the idea is to stay invested over the 10-year period. You cannot time it, right? Finally, it's important to know that the business cycles are inevitable. Economic cycles are inevitable, much like life cycle, and the ups and downs of the business cycles are part and parcel of the investment period or the investment life cycle. Stock market also goes through these cycles. They try to predict these business cycles. They are usually a leading indicator, and they indicate the business cycle ahead, and they also go up and down, with the business cycles. Now, we cannot really time the bottom and enter that period and get the upside. That's not really possible. Nobody can time the market so efficiently. Sometimes it's one time, you could do it 2 times, but not consistently. So the idea is to stay invested throughout the period. And drawdowns are pretty much nature of the market. That's the nature of the beast. Warren Buffett himself, his portfolio has gone down 50%. Berkshire Hathaway has gone down 50% drawdown during the entire invested tenure or over 40-50 years. So over a period of 30 years of investment period, 4 to 5 drawdowns could be possible, and there could be 2 to 3, 50% more drawdown on individual companies, right? Sometimes even 80%. That's inevitable. So we need to prepare our mind, especially when you're a beginner, to go through that volatile period. Volatility is something that you cannot avoid in stock market investing. And the returns are going to be non-linear because of the same factors, because of the same reasons, right? So these are the 4 basic things that you need to get right before you start investing in stock market. Thanks for staying with me. Signing off, Sandeep Anand.